Hi, this is Sally's Book Club. Tune in daily as we explore global literary gems for you. Today we're diving into Jesse Livermore's How to Trade in Stocks, the masterpiece blending time and price strategies. The name Jesse Livermore resonates throughout Wall Street like no other. Wherever financial markets exist globally, you'll find devoted followers of his methods. As the greatest trader and analyst of the 20th century, his Reminiscences of a Stock Pauperer remains essential reading for investing legends like Stanley Kroll.
Livermore's life was a roller coaster of dramatic ups and downs.
At 14, he began his financial journey as a quotation board boy in Boston brokerage firms.
He experienced multiple bankruptcies and remarkable comebacks.
In 1907, at age 30, he made his first million during the market crash.
The 1908 cotton market debacle with Percy Thomas nearly ruined him.
At 45, in 1922, his interviews with Edwin Lefebvre became the legendary Reminiscences of a Stock Pauperer. The 1929 crash made 52-year-old Livermore $100 million richer. This fortune equaled 2.4% of total U.S. tax revenue that year, an unprecedented financial feat.
His triumph turned bitter, as public blamed him for the crash, receiving constant death threats. Fortune abandoned him as legal battles and family issues accelerated his decline. 1934 saw 56-year-old Livermore bankrupt again.
At 62, in 1939, he penned his only authentic work, How to Trade in Stocks. This volume truly deserves the title Reminiscences of a Stock Pauperer. Here stood a man who'd survived life's ultimate market cycles. Though concise at 100-plus Chinese pages, this book distills Livermore's entire market wisdom. Bitter lessons carved from stock and futures market experiences. They say the best things come in small packages. Every sentence in this book carries profound wisdom. Livermore aimed to guide future traders away from pitfalls he once faced. Now, let's focus on two core concepts: stock selection and timing strategies. First, smart speculators never treat stocks like fixed deposits. To Livermore, even promising companies weren't safe deposit boxes. Take New Haven Railroad stock. $255 on April the 28th, 1902. Everyone believed it safer than bank deposits back then. By January the 2nd, 1940, just 50 cents per share. Chicago and Northwestern hit $240 in January 1906. Guess its 1,940 price. 31 cents? Such examples taught speculators to respect fundamentals, but not worship them. They focused instead on market price trends and momentum shifts. Successful traders act on market signals, recognizing financial markets' constant flux.
No one can predict how far a falling stock will drop.
Same logic applies to rising stocks. Their ceilings remain unknown. Livermore never shorted stocks, simply because they seemed overpriced. A stock rising from $10 to $50, check its profit potential before judging. Strong earnings outlook could push it to $150 from $50. Ever sold a good stock prematurely during its rise?
that panic selling after initial gains. Classic investor mistake. Then realized you sold at the bottom, filled with bitter regret.
This reminds many investors of Quaico Mutai, the share market's top-rated stock. Mutai hit 719 Chinese yuan and 96 cents in November, setting China's single stock price record. At 100 Chinese yuan, 200 Chinese yuan, 300 Chinese yuan milestones, people kept claiming it was overvalued. Even some value investors sold their positions. In hindsight, those prices were actually foothill levels. Livermore believed, stocks have distinct personalities like humans. Successful trading starts with understanding each stock's unique behavior patterns. Livermore emphasized focusing on market leaders when selecting stocks. Concentrate your firepower. Strike while the iron's hot with leading stocks.
He learned this through painful mistakes of his own.
Like the investment proverb, spread eggs across 3-4 baskets. Not 10 when you only have 10 eggs. If you can't profit from leading stocks, you can't profit in markets at all. So, how did Livermore implement this strategy? He tracked 4 leading sectors: steel, automobiles, aviation, and postal services. This didn't mean buying every stock in these sectors. First, testing his market prediction capabilities. Second, identifying fast-rising stocks within leading sectors. Market leadership changes constantly. Stay alert for emerging sectors. Today's trading software replaces manual tracking. While software ranks hot sectors, your personal market vigilance remains irreplaceable. Does buying leading stocks guarantee success? Of course not. Markets change rapidly, requiring constant strategy adjustments. Let's examine Livermore's classic case study. During a bull market, Livermore selected Utah copper and U.S. steel from favored sectors, initially buying 5,000 shares of Utah copper. When Utah copper underperformed expectations, he wisely stopped accumulating positions. With U.S. steel, starting with 20,000 shares, he kept increasing holdings to 72,000 as it outperformed. Utah copper remained at the initial 5,000 shares. Both positions were exited simultaneously, with vastly different outcomes. U.S. Steel generated $1.5 million profit through pyramiding successful positions.
Utah copper barely broke even due to stagnant performance.
This demonstrates Livermore's principle of adding to winning positions. Livermore stressed, true profits come from positions profitable from inception. The U.S. steel trade perfectly illustrates this philosophy. Whether long or short, maintain positions showing immediate paper profits. They tend to self-sustain.
Cut losses quickly on positions showing initial small deficits.
Stop loss means exiting losing trades decisively. For a shares investors lacking automatic stop-loss functions, set manual exit signals. Example: sell if 10% loss occurs, exit at $9 if bought at $10.
A major trading pitfall is averaging down on losing positions.
Consider someone buying 100 shares at $50, then buying more at $47 when it drops. Averaging to $48.50 makes break-even at $49 seem tempting, but dangerously misleading.
If price drops further to $44, total loss balloons to $900 from initial $300.
Continuing to average down during free fall magnifies losses exponentially. Neither averaging down nor stubbornly holding works in declining markets. Without leverage, you might wait indefinitely for price recovery. With leverage, refusing to cut losses leads to margin calls.
A Shanghai Futures. Traders 2017. Suicide tragically demonstrates this. His long rubber position, yuan 101M equity, on September the 13th dwindled to yuan 30M by September the 26th.
Adding yuan 40M more to losing positions accelerated yuan 110M total loss in 10 days. Rubber prices kept falling, culminating in 7% crash on September the 28th. Full margin long positions guaranteed liquidation. Never fight the tape. In ranging markets, you might survive bad trades through luck. In trending markets, stubbornness costs fortunes or lives. Never gamble against market momentum. Cultivate disciplined habits with small capital. Bad habits magnify losses exponentially as capital grows. Like the Rubber King we mentioned, his trades involved hundreds of millions. Without stop-loss discipline, even billion-yen positions can evaporate.
Livermore details his cotton trading failure in the book. 5 cotton purchases over 6 weeks each triggered immediate losses of $25,000, $30,000.
These consecutive losses bred anxiety and cotton market aversion. Livermore completely abandoned cotton trading. 2 days later, cotton surged 500 points with minimal retracement.
$1 million Australian dollars profit opportunity missed due to premature exit.
This failure reinforced Livermore's belief in trading discipline. The second core concept: timing entries, exits, using pivotal points. Livermore's crucial concept, the key point. What defines a key point? Breakthroughs at round numbers. $50, $100, etc. often trigger parabolic moves. This strategy brought Livermore major commodity trading success. These round numbers represent psychological barriers. Breakouts above key levels signal high probability continuation. Summer 1924. Wheat hit Livermore's key point. Initial 5M bushels bought. Bushel. Standard agricultural commodities measurement unit. Livermore's plan. Add positions at each new key point breakthrough. Second 5M bushel. Purchase rode a spectacular bull market. Livermore exited with 25 bushel profit. Massive gains realized.
He soon realized, underestimating the rally's potential.
Wheat surged 20 days after his exit. What next? Re-entering at 25 higher with 2 5M bushels. Half initial position. Held until danger signals emerged, securing substantial profits. The strategy constitutes trend following in directional markets. Key point breakthroughs served as his entry triggers. Livermore strictly followed trends, never bought dips, nor shorted rallies. At Anaconda, copper's $100 breakthrough, He bought 4,000 shares aggressively. The position gained 10 points intraday, rocketing past $150 swiftly. Repeating this at $200 brought massive profits through persistence.
The $300 level showed weakness. No immediate 10-15 point surge. Recognizing danger, he shorted. Price collapsed to $225 within weeks.
Key point analysis fascinated Livermore endlessly. He categorized key points into continuation patterns. Breakouts here typically ignited rapid price advances. Reversal patterns signaled trend changes. Trend reversal means transition between bull, bear markets. Anaconda's $100, $200 were continuation points. Buy signals. The $300 level became reversal point. Exhaustion signaled market top. Thus, Livermore's shorting at continuation points confirmed trends, while reversal points signaled new market directions. The Anaconda trade exemplified masterful long-short strategy execution. Livermore particularly excelled at reversal point shorts, earning his Wall Street Bear nickname through massive short profits. The book introduces specialized tracking tables for identifying key points in trends. Livermore considered these tables his market dictation key. Table design inspiration came from a California-based trader's remote trading approach. This hermit trader received 3-day delayed market data in mountain isolation. He executed only 2-3 annual trades through San Francisco brokers. And asked about his remote success, "I treat speculation as serious business.
Market noise distorts judgment. Failure becomes inevitable."
True, trends need time. Mountain isolation allowed letting bullets fly through market cycles. Daily market data recording maintained discipline. Trading only occurred upon confirmed trend changes. The book contains 16 such tables spanning March the 23rd, 1938 to February the 19th, 1940. Columns include secondary rally, natural rally, upward trend, downward trend, natural reaction, secondary reaction. Central columns recorded daily prices within corresponding trend categories. Simply put, Livermore used this method to distinguish between trend reversals and ignorable natural fluctuations. Through these tables, Livermore sought the master key to market movements. Young Livermore traded incessantly, chasing intraday price fluctuations. He recognized this error, vowing to ignore market noise. Modern trading software eliminates manual record-keeping. Focus remains on the core analytical question: how to determine if market trends have fundamentally shifted. Livermore focused on active stocks above $30, measuring April volatility thresholds. 6-point price movement became his benchmark after extensive testing. Movements under 6 points indicated sustained trends with normal volatility. 6+ point compratrend moves signaled potential trend reversals.
Single stock analysis risks misjudgment. Sector analysis requires multiple components.
Livermore created sector composites using 2 representative stocks. For steel sector analysis, U.S. Steel plus Bethlehem Steel Composite. Composites needed 12+ point combined movement, 6+ points each to confirm trend change. Example: U.S. Steel moves 5.125 points plus Bethlehem 7 points equals valid 12.125 point signal. Critical: measure from intraday extremes, not closing prices. For stocks above $30, sub-6-point fluctuations are normal volatility, not altering trend direction. Livermore strictly studied active stocks priced above $30. Adjust the 6-point benchmark for different price tiers accordingly. Readers should adapt principles flexibly, not rigidly follow parameters. Modern traders can apply volatility benchmarks for trend confirmation. Group stocks by price tiers: $50, $50, $100, $100 with respective volatility thresholds. Analyze sector composites like Livermore to filter market noise. This methodology targets major trends, ignoring insignificant fluctuations. Maintain long positions until trend reversal signals emerge. Reverse positions at trend. Reversal points applicable to algorithm trading. Set future stop-loss levels using these volatility benchmarks. Core principles from How to Trade in Stocks. Trade leading stocks aggressively. Avoid over-diversification. Execute trades only after key point confirmation. 2 key point types: continuation and reversal patterns. Profit by trading continuation patterns and reversing at exhaustion points.
Livermore's final warning: never average losing positions. Cut losses immediately.
Livermore's trading methodology achieved unparalleled mastery. Wall Street analysts attribute his downfall partly to 1933 Securities Act restrictions. Trading legend William Gann dedicated a chapter to Livermore in 45 Years in Wall Street. Gann regarded Livermore with professional admiration. Gann criticized Livermore's single-minded focus on profit accumulation over wealth preservation. His weaknesses: insatiable greed and power obsession. Large fortunes impaired his trading discipline. Livermore's habit: withdrawing $200,000, $300,000 profits, saving half as realized gains. These savings funded luxury purchases rather than prudent investments, he confessed to his son. Market profits fueled failed ventures beyond his expertise. Disastrous investments included Florida real estate and experimental aircraft companies. This beskews the vital importance of specialization. Financial markets were Livermore's domain of genius. Aviation, oil drilling, real estate, fields beyond his comprehension. Venturing outside expertise guaranteed catastrophic losses. This book distilled 48 years of market experience when written, chronicling 42 Wall Street years since his arrival at 20. November the 28th, 1940. Livermore's life ended by suicide. The curtain fell on a financial legend. Yet, Livermore's strategies remain Wall Street gospel inspiring traders globally. Many Chinese devotees adopt Jesse as their English name, keeping their idol's legacy alive. No other figure in financial history commands such devotional following as Livermore. 2017 marked the 140th anniversary of Livermore's birth. May Livermore's legend continue inspiring generations of market practitioners. This concludes our analysis of how to trade in stocks. Study notes available below until tomorrow.